Most people think that once tax season rolls around, their tax bill for the last year is set in stone. They think that they are stuck with whatever number their software or their accountant spits out. But today, I'm here to tell you that that is not 100% true. You can actually create tax deductions and change your tax outcome after the tax year has actually ended. And today I am going to give you a free masterclass overview into 10 powerful strategies that will allow you to do this as a licensed CPA that tax plans every day at mycpacoach.com. So let's jump right in. Okay, so there are 3 critical areas that we are going to explore to uncover massive tax savings. Number 1, checkbook strategies. Now, these are different accounts that we can move money into that will reduce our taxes for the prior tax year through something called late contributions, which the IRS allows. And then we'll get into number 2, deduction methods. For many deductions, the IRS actually gives us multiple options to choose from, and we want to choose the best deduction method possible under the latest tax rules. And we'll go over some best practices on how to do this. And then we will end with number 3, late elections. Now, this is where we will talk about ways to actually change how you are being taxed by the IRS on your returns through something called late elections, which is also something that the IRS routinely accepts. So let's warm up here with some very easy checkbook strategies, like number 1, the late IRA contribution. So if you do not know, an IRA simply stands for individual retirement account, and almost anyone with earned income of some form can contribute to it and receive various tax benefits. And your contributions into a traditional IRA are 100% deductible when you meet certain requirements. So you are basically receiving a tax deduction for simply saving for your own retirement. And what is even better is the fact that the IRS allows you to make late contributions into your traditional IRA after the year has actually ended. For example, in 2025, individuals could contribute up to $7,000 to $8,000 into their own IRA, depending on their age. But let's say it's now 2026 and you forgot to make your contributions, or you simply did not have the funds available at that time to make it. Well, the IRS grants you until the federal tax filing deadline of April 15th of 2026 to make a contribution into your traditional IRA for the prior tax year, even though that year has ended. A move like this could easily save someone in a high tax bracket a few $1,000s in taxes, but be sure to review the criteria to qualify for this, as there are some income exceptions that may apply to individuals, especially those who are participating in 401k plans as well. Now let's go over another easy checkbook strategy with number 2, late HSA contributions. Health savings accounts is another checkbook tax return strategy that grants you a tax deduction for simply moving money into it. And you can even take money out of it tax-free when you use it for qualifying health expenses. So you are basically getting a tax deduction for saving for your own health expenses, and you would never pay tax on the funds you put into that account as long as you use it for its intended purpose. And all you need to qualify for an HSA is a high deductible health insurance plan. And if you qualify for it during that tax year, the IRS allows you to make late contributions into your HSA for that tax year, even after it ended. For example, in 2025, individuals were allowed to contribute around $4,000 to $8,000 or so into their HSA. And if you did not make the maximum contribution into your HSA before the year ended, the IRS would allow you to make that contribution by the tax return deadline of April 15th. And if you do that, that deduction can apply to the 2025 tax year if done correctly, which again could easily save someone a couple more $1,000s in taxes or even increase their tax refund. Now let's move on to one more checkbook strategy before we get into the next key area here, which is number 3, late solo 401k or SEP IRA contributions. So in 2025, the IRS allowed qualifying individuals to contribute up to $80,000 into these accounts, depending on their age and income. And yes, you can make late contributions into these accounts after the tax year has ended as well, and deduct the entire amount. Because the contribution amounts are so large, a lot of clients I work with are actually unable to maximize their contributions to these accounts throughout the tax year for various reasons like cash flow concerns, for example. But sometimes before they actually file their taxes for those tax years, those funds become available. So what happens is that instead of paying the IRS a bunch of money in taxes, they instead choose to fund their retirement accounts to offset their taxes. So how exactly does this work? Well, SEP IRAs and solo 401ks are self-employed retirement accounts. So you do have to earn some form of self-employment or business income in order to qualify for this, which can even include income earned from a side gig or 1099 contract. And when you have an account established, the IRS allows you to make late contributions into these accounts for the prior tax year up until the tax extension deadline, this time of either 9/15 or 10/15, which will depend on your business structure and how you file. So if you file an extension, you actually have more time to make this contribution, which I've seen clients do and save tens of thousands of dollars in taxes. Now, there is some nuance to how those late contributions actually work. There are different rules for employer contributions versus employee contributions, and also different rules for different entities like sole proprietorships versus S corporations, for example. Just comment retirement below if you want me to make an in-depth video on this topic, but for now, let's move on to some other key areas. So we just went over some very common checkbook strategies that, again, can be used and implemented after the tax year has ended to reduce your taxes before you actually file your taxes. There are also some other powerful ones that I did not mention that are not as popular, like cash balance plans, defined benefit plans, and even simple IRAs that have high contribution limits and similar IRS rules for late contributions. So be sure to look into that if that is of interest to you. So let's move beyond the checkbook strategies and talk about some things that we can implement for free that simply requires us to make some good decisions when we're filing our tax returns, like choosing the best deduction methods. We'll start with a very simple one that applies to almost everyone watching this with number 4, choosing between the new itemized and standard deduction. Now, this single decision can be the difference between you saving thousands or paying thousands more in taxes, and every taxpayer has to make it. Now, before the new tax rules, about 90% of taxpayers took the standard deduction when they filed their returns, which is still a strong deduction to take, but there has been some key changes, so let's walk through this. So in 2025, the standard deduction was increased to nearly $16,000 for single taxpayers, a little over $23,600 for head of households, and $31,500 for married filers. And in general, if your itemized expenses, like your out-of-pocket medical and dental expenses, your mortgage interest, any charitable contributions you make, and your state and local taxes, if they do not exceed this, then usually that means the standard deduction is more beneficial for you. But there's one big change that will change this for millions of people, and that is the new SALT cap increase to $40,000 under the Big Beautiful Bill. If you pay a lot of state and local taxes like property tax or sales tax, for example, the itemized deduction with this change might actually save you more money on your taxes in 2025 when compared to prior tax years. And even if it does not, it's always a good practice to have your accountant calculate what your itemized deduction may be anyway, when compared to your standard deduction, just to make sure that you are not leaving any money on the table at tax time. Missing $10,000 in deductions could easily cost someone in the highest tax bracket over $3,000 in extra taxes, and all you have to do to avoid this is simply choose the best option. The same applies to strategy number 5, the vehicle tax deduction. The new tax rules introduce a new car loan interest deduction that allows us to write off up to $10,000 now of interest on a car loan for vehicles that were assembled in the US and used for personal use. And that's just something you do not want to miss if you qualify for it. And for business owners, we also have the new 100% bonus depreciation rules, which may allow you to write off up to 100% of a new vehicle, depending on the weight and use of that vehicle. But here's the trick. You still have to select the best deduction method to use. The IRS gives us two methods to calculate our vehicle tax deductions. And I always tell clients that whenever the IRS gives you two ways to calculate one thing, please believe that one of those methods will save you more money in taxes than the other. And when it comes to vehicles, we have the mileage method, which grants a fixed tax deduction per business mile we drive. And we also have the actual expense method, which instead allows us to deduct our actual car expenses plus things like depreciation, for example. Now, there's no one-size-fits-all approach to picking the best deduction method here, other than calculating both of them and seeing which one of them saves you the most money in taxes. And if we were to take this one step further, we'd also look at strategy number 6, choosing the best depreciation methods. So whenever you buy any tangible asset for your business, whether it's a new vehicle, equipment, machinery, or tools, you are generally allowed to take depreciation on that item. But what complicates this is the fact that the IRS gives us a bunch of different depreciation methods to choose from. There's straight line, double declining balance, bonus depreciation, Section 179 depreciation, accelerated depreciation, and probably much more than that. And without getting too technical here, you simply want to make sure that you are choosing the method that saves you the most money in taxes. Right now, most tangible assets can be 100% expensed through either bonus or Section 179 depreciation. And before you file your taxes, you will just want to make sure that you are not missing these types of deductions when you in fact qualify for them. And as a catch-all, you should also seek to claim number 7, all new big beautiful bill deductions. So in addition to 100% bonus depreciation, the new tax rules also reinstated the 20% QBI deduction for business owners with new limits and income exceptions. And so many business owners actually qualify for this now under the new rules and do not even realize it. Plus, we also have a new tips deduction, a new overtime deduction, plus a new senior tax deduction, which are all deductions that you simply do not want to miss if you qualify for them when you file your 2025 tax returns. So to wrap up this entire deduction section in one sentence, we just want to make sure that we choose the best deduction method available whenever we have multiple options. And we also do not want to miss a single new tax deduction that just came out. If you do this, you will give yourself a good chance to reduce your taxes to the largest extent. But now I want to switch gears here and talk about ways to change how your income is actually being taxed by the IRS altogether, which can open the door to more savings here. And this can be done by making late elections with the IRS. So let's walk through this by looking at strategy number 8, the Late S Corp election. So what shocks a lot of self-employed individuals when they file their taxes is something called self-employment tax, which shows up on a separate line item of your tax return. Now, this is a 15.3% additional tax on all of your self-employment income up to a certain limit. And I constantly see small business owners paying tens of thousands more in taxes due to this tax alone. And eventually they realize that they can largely reduce this tax or avoid it by simply forming an S corporation or C corporation. But the problem is that they usually realize this too late, and that is where the Late S Corp election becomes extremely valuable. So generally, in order to make a timely S Corp election, you have to make your election within 75 days of forming your business or by March 15th of the tax year. However, most people do not know that the IRS offers late election relief through Revenue Procedure 2013-30. which allows you to request retroactive S Corp treatment within 3 years and 75 days from the date of your election. So just imagine being subject to $20,000 in extra self-employment taxes because you're taxed as a sole proprietor or partnership. And then you simply make a request with the IRS to have them change your classification to an S Corp, and you end up avoiding that entire tax. Well, that's 100% possible, but you do have to meet certain IRS guidelines, with the major one being that you have to have a reasonable cause that explains why your election was not filed timely. Just comment Late S Corp below if you want me to create a dedicated video on this topic, but in general, I would advise working with a CPA if you're trying to implement something like this. Now let's talk about another election strategy with number 9, the late PTET election, which stands for pass-through entity tax. And this basically allows your business to pay and deduct your individual state income taxes when the business pays for it. For example, let's say you have $20,000 of personal state income tax that you are not deducting. Well, with an approved PTET election, your business would pay this tax for you and be able to deduct the entire amount on its taxes, which saves you money because now you're reporting less income to the IRS. And here's the good news. Many states actually allow you to make a late election for this, which may allow you to implement this before you file your tax returns. And some states even allow you to do this when you file your tax returns. Now, with that said, there are some states that do not allow PTET elections at all. And there's others that do, but do not grant late relief. So be sure to look into your state's rules or talk to your CPA about this. Now let's move on to another little known election/correction that can save you a bunch of money in taxes when used correctly. With number 10, the 3115 accounting method change. Now this form allows you to claim big deductions you may have missed in prior tax years, or even change your accounting method altogether, which may result in you paying less taxes. For example, let's say after watching this video, you realize that your accountant either missed an accounting method or used a slow depreciation method in prior tax years, resulting in a higher tax liability. Maybe you were taking straight line depreciation on a vehicle you purchased when you could have expensed it with 100% bonus depreciation. Or maybe you own a rental property and later realize that you could have just done a cost segregation study to write off a lot more of that property on your taxes. Or on an even simpler level, maybe you started a new business a few years ago and realize you never deducted your startup cost or organizational costs correctly. Well, when you miss deductions like this because of your accounting method or how you're tracking them, then you may be able to claim all of them as deductions on your current year tax return with Form 3115. This form basically tells the IRS that you are updating your accounting method to the best method available, and you would like to take all of the money you are owed right now. And those are just examples, but there's even more you can do with this when it comes to accounting methods. For example, there's cash accounting, accrual accounting, and different ways that may allow you to time how you report your income and expenses, and so on. But honestly, this stuff requires a true technical understanding of the rules, and I would not even try to do this without the guidance of a competent CPA. And if you need one, just apply to work with my team today at mycpacoach.com.